Hi, I am Archit Garg, a student of 2017-19 batch of IIM Trichy. This is my video presentation for the course Indian Economy and Policy on the causes of 2008 economic crisis and weighing the chances of it happening again. The 2008 financial crisis is the worst economic disaster since the Great Depression of 1929. It occurred despite Federal Reserve's and Treasury Department's effort to prevent it. 2008 crisis led to Great Recession when housing prices fell 31.8% more than during the Depression. 2 years after the recession ended, unemployment was still 9%, and that's not counting discouraged workers who had given up looking for work. Now, let us try and look what are the causes of 2008 financial crisis. The first sign that the economy was in trouble occurred in 2006 when housing prices started to fall. At first, realtors applauded. They thought the overheated housing market would return to a more substantial level. Realtors didn't realize there were too many homeowners with questionable credit. Banks had allowed people to take out loans for more than 100% of their value of new homes. Many blame the Community Reinvestment Act that pushed banks to make investment in subprime areas, but that wasn't the underlying cause. The Graham-Rudman Act was the real villain. It allowed banks to engage in trading profitable derivatives that they sold to investors. These mortgage-backed securities needed home loans as collateral. The derivatives created an exorbitant demand for more and more mortgages. The Federal Reserve believed the subprime mortgage crisis would remain confined to the housing sector, but Fed officials didn't know how far further damage would spread. They didn't understand the actual causes of the subprime mortgage crisis. Hedge funds and other financial institutions around the world owned the mortgage-backed securities. The securities were also in the mutual funds, corporate assets, and pension funds. The banks had chopped up the original mortgage and resold them in tranches. That made the derivatives impossible to price. But the question is, why did substantial pension funds buy such risky assets? They thought an insurance product called credit default swaps protected them. A traditional insurance company known as AIG sold the swaps, but the derivatives lost value. AIG didn't have enough cash flows to honor all these swaps. Banks panicked when they realized they would have to absorb the losses. They stopped lending to each other. They didn't want other banks giving them worthless mortgages as collateral. No one wanted to get stuck holding the bag. As a result, the interbank borrowing cost, known as LIBOR, rose. This mistrust within the banking community was the primary cause of the 2008 financial crisis. Now, let us look at, can this happen again? Can 2008 financial crisis happen again? Many legislators blame Fannie and Freddie for the entire crisis. To them, the solution is to close or privatize the two agencies. But if they were to shut down, the housing market would collapse. That's because they guarantee 90% of all the mortgages. Furthermore, securitization, bundling, and reselling loans has spread to more than just housing. The governing must step in to regulate. Government passed the Dodd-Frank Wall Street Reform Act to prevent banks from taking on too much risk. It allows the Fed to reduce bank size for those that become too big to fall. But it left many of the measures up to the federal regulators to sort out the details. Meanwhile, the banks keep getting bigger and are pushing to get rid of even this regulation. The financial crisis of 2008 proved that banks could not regulate themselves. Without government oversight like Dodd-Frank, they could, in future, create another global crisis. Thank you. This was my presentation for IEP, the course by Somin Majumdar.